Talk about default risk. Up until now, we've been talking about treasury bonds, which have no risk of default, effectively. If an issuer defaults, that is, doesn't pay what's been promised, then the investors receive less than the promised return. Therefore, the expected return on corporate and municipal bonds is less than the promised return. How do you determine the amount of default risk? Well, we'll look at their financial strength and the terms of the bond's contract. First, we'll look at some ratios that give us some information about the risk of default. We look at three ratios: the debt ratio, times interest earned, and the current ratio. I was a commercial lender, and these were the three most important ratios we looked at when making a decision whether or not to make a loan to a company and what rate to charge. So we can look at debt to total assets or total liabilities to total assets. EBIT, earnings before interest and taxes, also known as interest coverage. Sometimes we'll look at EBITDA, EBITDA, divided by interest and total payments related to the bond or the loan. Current ratio is just looking at currently can they cover those obligations. Then we'll look at the provisions in the bond contract. If the bond is secured, that would get a higher rating, less risk of default, something there. Senior debt gets paid before subordinated debt. There may also be sinking fund provisions, and shorter maturity debt usually appears to have less of a risk of default. Moody's, Standard & Poor's, and Fitch's will rate the bonds. Your best ratings are AAA, meaning the ability to pay is very strong. AA, still very strong. Single A, and Moody's says BAA, Standard & Poor's, Fitch, BBB. It's medium grade. It's more susceptible to changes in circumstances, but still it can pay. Anything lower than that would be considered as a junk bond, with D being in default. So if you want more details, see the notes page. If you click on this link, you will see information about corporate bonds. Here are some of the corporate bonds that are investment grade. Some companies you may have heard of, like Apple, Citigroup, Union Pacific. And you can see these are their spreads over treasuries. They're all at a higher yield to treasuries, and these have gone down. Over here, looking at some high yield bonds, another word for junk bonds, you see some other terms you may have heard of, such as Sears, Caesar Entertainment, and you can see that these have here a price, for the most part, that is below par, the yield being higher than the coupon rate. And that is especially true when we look at the junk bonds here that have had the spreads that widen, and you can see all of these are trading substantially below par. These are bonds that are not so good perhaps to invest in right now. You can get more information from the Wall Street Journal and other places. This is just to give you an idea. The Treasury curve, you can see through all maturities, is lower than that of the AAAs, which is lower than that of the BBBs. So the higher the risk, the higher the required return when you buy the bond. During the financial crisis, you can see that the spreads widen, especially for over treasuries, and you see it especially wide for the BAAs, the lowest investment grade corporate bonds, and this you can see it was almost 600 basis points in March of 2009 over treasuries. And you even saw this here on short term. And that is a little description of default risk. There will be some problems we'll work out in the data case looking at yields on corporate bonds. Thank you.